Hey guys, so today I wanted to walk you through a strategy that's often overlooked, but for the right household can shave years off your mortgage and save you tens, even hundreds of thousands of dollars in interest. My name is Brandon Van Dyke, and I'm a mortgage broker located in Langley, BC, and I help people across Western Canada with mortgage strategies that can help you save tens of thousands of dollars in interest and shave years off the life of your mortgage. Today, I'm going to be talking about the power of the paycheck using the Manulife One product. This is a unique approach that combines your mortgage and your bank account and lines of credit into one flexible account. And when it's used properly, can completely flip the script on how most people manage their mortgage and their monthly cash flows. So let's get into how it works, who it's for, and how it can completely change the way you look at debt. So what is the Manulife One? The Manulife One is what's called an offset mortgage or an all-in-one account. It can combine your mortgage, line of credit, and your everyday banking into one single account. So instead of having your paychecks deposited into a separate checking account while your mortgage sits untouched, every dollar you bring in is immediately applied against your mortgage balance. Why is that powerful? Because interest in the Manulife One mortgage is calculated daily, and the lower your daily balance is, the less interest you pay. So when your income hits that account, your mortgage balance drops. Even if it's only for a few days, that's going to reduce your interest costs. And the longer you keep that money in that account before spending it, the more it works in your favor. This is going to be the exact opposite of a traditional mortgage, where you're locked into a fixed payment and your extra cash is doing nothing for you until you decide a lump sum prepayment, and even then, you're capped at annual limits. Let's look at this strategy in action. So I'm going to walk you through a real example of how this would work for someone with strong cash flow. Let's say the household owns a home worth $800,000. They have a $600,000 mortgage and they're earning $14,000 per month after tax. And their total monthly expenses, not including their mortgage, are around $5,000. That leaves them with about $9,000 of monthly cash flow available to put towards their mortgage and savings. Now, under a traditional mortgage, they'd be making fixed payments based on a 25-year amortization, and any extra would have to be manually applied if they want to accelerate their paydown. Even if they make occasional lump sum prepayments, they're limited to a certain percentage each year. But with the Manulife One, here's how things could change. So instead of letting that cash sit in a regular checking account where it just sits until it's used for bills, every dollar of it hits that mortgage account. The moment that money arrives, it's reducing your mortgage balance and your interest costs right away. Let's say you spend $5,000 each month on living expenses. If that money gets deposited into this account, even for a week or two before spending it, that's a week or two of reduced interest every single month. And over time, that is going to add up. So how much does it really save? In this example, the household still has 23 years left on their mortgage. But by using the Manulife One and applying their leftover monthly cash flow automatically without any extra effort, they could pay off their mortgage in just 15 years. That is 8 years faster, and the total interest savings over that period would be just over $189,000. That is not from investing more money or from risky moves or hoping the market goes your way. That's just from restructuring on how their money flows through their mortgage. And why does this work so well? Because the strategy aligns perfectly with how interest is charged. Daily, not monthly. So the moment your income hits, it's reducing your balance, even temporarily. And when you spend less than you earn, like in this case, that difference stays in the account, knocking your balance down faster and faster. It can also help build sort of an emergency buffer Instead of keeping your emergency fund in a low interest savings account, it can sit inside your mortgage account, reducing your balance and interest while staying fully available if you need it. This way your money is always working for you and you're not losing time or return keeping it in idle. So who is this best used for? The strategy works best for people with consistent and strong income, positive monthly cash flow, a desire for flexibility with their debt repayment, and ideally people who are a little more disciplined with their spending. If you are someone who tends to leave money sitting in their checking account or you're saving up for something short term, the Manulife One gives you the ability to reduce your interest costs while still keeping that money accessible. A few more benefits to keep in mind is you can skip a payment on the portion of your mortgage without any penalty if needed, since that is a line of credit technically. You can skip a payment without penalty if needed, since it is a line of credit. You can also borrow back equity instantly without refinancing, and you also get daily interest savings instead of being stuck with a rigid monthly amortization schedule, and you still have the option to invest, pay down faster, and keep cash liquid. There is also a psychological benefit to seeing your mortgage balance drop in real time. Every purchase and every deposit directly impacts your loan balance. It can create more awareness and in many cases more motivation to be smart with your spending and accelerate your paydown. Now the flip side, there's a few things you need to watch out for. This strategy works beautifully when you're disciplined, but it does require a certain mindset. Because your mortgage is now linked with your daily spending, it's important not to treat it like free money. If you are consistently borrowing back your progress, it defeats the purpose. It is flexible, but like any flexible tool, you need to use it with intention. Also, the Manulife One tends to be higher than a traditional mortgage rate, but because you're reducing the balance every single day, your effective interest rate can end up lower than a fixed rate mortgage over time, especially if you're accelerating payments or keeping more cash in the account. In our earlier example, the household had a $600,000 mortgage. If they kept that balance for 23 years on a traditional mortgage, they'd pay nearly $190,000 more in interest. With the Manulife One, they knock 8 years off of their loan and save that interest just by using the strategy intentionally. So if you're someone with strong income, positive cash flow, and you want to be more efficient with how you manage your mortgage, this strategy is absolutely worth exploring. The power of the paycheck isn't about putting in more effort. It's about letting your income do the work automatically. Instead of letting your money sit passively in a checking account while your mortgage racks up interest, you're using every dollar to bring your balance down in real time. So if you want to see what this could look like with your numbers, how fast you could be mortgage free, and what kind of interest savings you'd see, feel free to reach out. I'd be happy to run a personalized Manulife One analysis for you. And if you found this helpful, make sure to like the video, subscribe to the channel, and share it with someone who's serious about getting ahead on their mortgage. Thanks for watching, and I'll see you on the next one.